The impact of coronavirus on the global economy is growing and spreading daily. What started as a medical emergency in the Chinese city of Wuhan has led to planes being grounded, cruise ships being quarantined, theme parks being shut, and car plants being mothballed. Financial markets remain confident the crisis will soon blow over. So joining us from Bulwark Capital Management in Seattle is their Chief Investment Officer, Zach Abraham. Zach, markets reacted initially but have since shrugged it off for the most part. How do you think this will play out in financial markets going forward?
Well, I'll tell you what we've done. We've added back a 15% position in U.S. Treasuries because I think that if this is something to be worried about, I think U.S. for a variety of different reasons, Treasuries and gold will catch a bid, just kind of in a safe haven deal. And I think it's really important to point out that we got to look at this thing in terms of there's the humanitarian side of it where it's awful. We all hope that they come out with a solution, okay? And then doing what I do in my business, I sound like the feelingless capitalist type guy, but our job is to take care of our clients' money and protect it no matter what. So on the financial side, this is more than likely a storm in a teacup, right? This is more than likely not the extreme outcome, not this global pandemic that's going to tip over the global financial system. The one thing puzzling about it to me, though, and the stats we're hearing about it, I've listened and read to some interviews and some reports from epidemiologists, and the one thing I will say that's concerning to me, or the most concerning thing to me about this whole situation, is watching the Chinese government response. Because they're saying one thing and they're doing another. I don't think that people, especially here in the Western world, are fully aware of the extent that the Chinese government is going to suppress this. You got 8-lane highways going into Shanghai and Beijing, massive cities that are empty, that are ghost towns. We're hearing stories about, and I cannot verify this yet, it seems extreme, yet there are some viable sources of information that we are listening to, saying that Chinese oil demand has already dropped 20% in the last month. That seems too big to be true to me. At the same time, you've got to handicap it and sit there and go, okay, possibly it is. If that is true, this is a lot worse than the Chinese are admitting. And the reason that is scary to me is that when you look at a country like China that has made up 50% of global growth over the last decade, that is so indebted that has to rely on a currency that nobody around the world trusts, and they have to take advantage of their ability to print that currency into perpetuity to keep this giant debt bubble of theirs afloat. There's this thing in economics we refer to as the Minsky moment, which is an ode to Hyman Minsky, economist that came to fame in the 80s. He wrote his work sometime before that, but it became very popular in the 80s. And there's something we refer to as a Minsky moment, where when something is inherently unstable, that we always attribute the little thing that comes along that knocks it off. We go, oh, it happened because of. And the analogy they use is balancing a pencil on your finger, right? You're standing on the side of a street, truck drives by, the wind from the truck knocks the pencil off your finger, and the guy turns to his buddy and says, hey, why'd that pencil fall off my finger? And he goes, well, it was the truck. And he goes, no, it was because the pencil was unstable, right? It was only a matter of time until something knocked it off. When you look at China's economy, that is unquestionably the state of affairs. And I am not saying this is the event that will tip it over at all. It's way too early. I don't know. I don't think there's any way to see that coming or know if that's coming. But that is one of the situations that we're looking at. I think that's the big threat. I don't think it's likely that it plays out, but I think that if we're looking at this through any lens, that to me is the economic threat. If China rolls over and this causes political unrest or social unrest in China, we're already seeing Chinese government officials walk back GDP reports, which is, again, troubling. This has been a problem for a month, right? It shouldn't be having this big of an impact on an economy. So that's certainly something to keep in mind. But, again, I will still say, maybe a situation to add, some U.S. Treasuries to the portfolio, maybe a slice of gold and all that kind of stuff. But we are not at a place where people should be gearing their entire portfolios or their whole investment philosophy around this scenario. It's too early for that.
And what do investors need to do, and what do we learn from this?
I think that the one piece of information or piece of data that investors should glean from this is that we live in a global financial system like we do now, where the days of if there's a recession in China, it doesn't bother us here in the United States. Where those days are over. You've got global trade making up such a big part of things these days that things go wrong. And one of the reasons that as value investors that we are and risk managers for our clients is that it's to keep a good eye on risk. And you go to the opposite end of the table. In 2008, 2009, clients were way too consumed with risk, and they were not properly managing risk to the upside. Right? It was the whole world's falling apart. We are at the opposite end of that scale now. And I think everybody is just assuming that nothing is going to go wrong. And just like we made our call on radio a year ago about Boeing, just saying, look, guys, this thing is priced to absolute perfection. Nothing happens perfectly. Buyer beware. Caveat emptor. And I think it's a great tool to remind investors, guys, there are risks out there. There is always risks. They're always lurking. And this is why you need to be disciplined as an investor. This is why you need to manage your risk properly. This is why you need to have more of a plan than just risk on, risk off, and stocks all the time, right? Nothing goes up forever. And I think if there's anything that investors should do, that's it. Use this as an example. It most likely won't be a disaster, but use it as an example to remind yourself that, look, anything can happen. And this is exactly why you want to be careful about paying too much to buy stocks, to paying too much to buy any type of investment. And you need to look at things from a fundamental perspective, because risk will happen. Bad things will happen. And a lot of times, the worst things can start off. It's like the butterfly effect, right? The butterfly flaps its wings and, 30 years or 30 days down the road, you've got nuclear war, right? Again, that sounds hyperbolic, but I'm just saying, you have an inherently unstable system, and we need to be conscious of that, and we need to acknowledge that anything could tip it over.
My guest has been Zach Abraham in Seattle, Washington, and this is Retirement News Online.